Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Adam Whitlam, head of Canadian rate sales. This week's episode is titled Up in Smoke. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Hi, Adam. Welcome to summer.
Hey, Ben. Thanks for having me back. It's been a while. Last time I was on here was the beginning of April. I was starting to think that maybe I'd been blacklisted.
Well, I actually, you know what? I think you're a little early in the rotation, to be honest with you. But I've had a bunch of traders on in a row, and although I had Rob last time, I guess, but I thought we could use a bit of a change in tone here. You're always an excitable person, so let's get exciting.
Lots changed since the last time I was here. I mean,
has it?
Then there was a war. Wait a minute. And there was noise about USMCA and a trade situation with the U.S. Wait a minute. And yields were back around 4%. Wait a minute.
10-year yield. Oh, I guess long bond. Long bonds. That's true. Okay. Yeah, in Canada. So we're all in the same. So nothing's changed, you're saying. So we should just recan the April episode. And
actually, to be honest, so I know this is going to be, I don't think anyone's done this on your podcast yet, but one thing I was thinking, we are kind of in the summer doldrums, volatility is low. We have some stuff to talk about with what's going on in the market right now. But one thing I kind of wanted to do, and I thought it'd be kind of neat to do, is to actually look back and talk about some of the things that we discussed back in that April episode and see how they panned out.
We could do that. So I try not to do that because I know that I'm usually wrong. So I don't want everyone to know that.
That's why I thought this would be a fun exercise.
What I thought you might say is you were going to try and bring in some sound effects because I know you've mentioned that in the past. But this works too.
I'm more of a fireworks guy. More visual learner.
So what did we say in April?
So I had to look at this myself because I was curious, and I do like when I talk to clients, and we're often out there marketing trades and trade ideas, and one thing that clients have told me time and time again is that they actually appreciate it when their coverage person is mentally keeping track of some of the trades that they're putting out there. So I decided, on this episode, it might be kind of interesting to have a look back at some of the trade ideas we put out and some of the things that we were considering back then and see how we did. So I had a look. And I can tell you it was not as bad as that look you're giving me would suggest. We actually did all right.
Both of us? Just you or me also?
No, both of us.
Oh, good.
Now, it was a long episode. We put a lot of things out on the table. So inevitably, I'm going to focus on the ones where we did better and not so much on the ones where we did worse, but we'll talk about a couple of dynamics. So back on that episode, we were talking a lot about inflation. Inflation was really a hot button issue because, we were going to get some pretty big month-on-month prints. Gasoline was skyrocketing, oil to the moon, whatnot. So inflation was a concern. We were talking about broad-based inflation. And I think it's really interesting to look at the rhetoric from the Bank of Canada and how that has changed over the meetings since April. I mean, we had the surprise in the statement, or in the opening remarks, I guess, where they talked about back-to-back hikes if necessary. Consecutive hikes. And so it almost seemed like the bank itself was a little bit surprised in their most recent statement about what I would say is the lack of a breadth of inflation given what's gone on in energy. Okay. So they really did, that opening statement was quite a bit different than the one prior. I think their stance has definitely been different. So I get the sense that they were a little bit surprised by the fact that inflation remained fairly contained. Also, we talked a lot about index extension. It's kind of an early index extension talk. So that was one area, we were proponents of 10s, 30s box trades, flattening in Canada. The curve was around 42 in 10s bonds. Lo and behold, it's 41.5 today. So that hasn't really moved very much. The box, however,
it did flatten in the interim.
It did. The box flattened and then it got absolutely annihilated.
Yes.
And that had nothing to do with the dynamics. Our conversation was around the index extension. What we didn't account for or didn't expect was the massive hyperscaler growth in the Canadian market, which really decimated our long end. Our market wasn't really prepared to take on the amount of duration that these hyperscalers entering the Canadian market brought in. And so, I think that was an overwhelming factor, combined with, what I would say is a significant move in real yields in the US, which has really put a lot of pressure on their curve as well. The other thing I would talk about is we talked a little bit about Bank of Canada pricing. So at the time, DEES was priced for almost 2 hikes, just inside of 2 hikes. And we liked receiving that against fading some of the shorter gaps like June, September. Well, June, we know nothing happened. No surprise. September also has kind of come in nicely. So I'll give us a pat on the back. Those spread trades were 35, 37 basis points. Now they're like 15 basis points. So that worked out pretty well.
Good job.
And then the other one, which I really would love to highlight, was we talked a lot about Ontario 37s, how Ontario 37s look cheap. At that time, Ontario had not yet done their new 2036 bond that was getting talked about and what level it might come at, what the credit spread would be. So those Ontario 37s did real well. The spread on those has tightened probably 12 basis points since we were talking about it. For comparison purposes, Ontario longs have tightened maybe 7.
All right, so that's pretty good.
So that trade worked out pretty well as well. So a little kudos to us on that one.
Okay, so it's not completely useless. That's
no,
good.
No,
good.
So a mixed bag, but
where was the mix? Where was the bad part?
Well, the box we didn't do super well on.
Did I propose the box as well?
It might have been.
I've been super hesitant on the box just because I don't know what the U.S. is going to do.
It might have been me.
And the Canada side did flatten, although then it steepened out hard immediately afterwards. But we did flatten 10 and then steepen back out. I may have been a little bit easier on it at the time, but I don't know. The U.S. side of the equation is something I have trouble wrapping my mind around. And that hasn't really changed.
No.
I still have trouble with it. Okay, so that's the past. What about the future? What do we want to talk about now? So we had the Bank of Canada last week. They sounded more at ease, but oil prices are since, I don't know, $5, $6, $7, $8, $10 higher. So that's an issue for them. That's why they are worried about any inflation issues is because there's the potential for that to spread to other products. Haven't seen that yet, but the higher oil goes, the longer it stays here, the more likely it becomes. And we got a lower inflation print. So that, again, but history there too. That was for June. Oil's higher since then. They were also more upbeat in their growth forecast. And at the time that sounded reasonable-ish. Q2's on pace for a little bit better than 2% probably. And Q3, I don't know, we'll see, flip a coin. But now we have a new tariff threat, which was not on the table when they met. And so, I don't know, maybe that all goes out the window on August 19th.
Yeah.
I don't know. Where do we go from here?
Well, it's been the last month or two has been your typical summer doldrums. We've had some headlines. We've had some rate vol instances here and there. Like this past week, we had a lot of movement in Canada-US. That spread differential is starting to get punchy again, but we know why. Like you said, CPI on Monday came in pretty light, lower than expectations. That put a good bid into the front end of Canada. What's been really interesting, actually, is we've seen a lot of the OI in short 2-year futures, 5-year futures, 10-year futures are starting to really tick up.
OI is open interest.
Yeah, good point. Yeah,
just to help out.
Open interest in the futures have really been ticking up quite a lot. So there's been a lot of algo involvement, a lot of algo support for our market, which is one of the reasons that the front end in particular has been very well supported, and one of the reasons that sort of D-step trade worked out pretty well. So yeah, from here, I don't know, we're back into an environment where outright yields look attractive in the long end of the curve. We see clients starting to dip their toe back in around 4%. But then when you compare to where, say, US yields are in the long end at 5.13, 5.15, Canada comparatively looks kind of expensive. And it's kind of expensive more so in the front end of the curve. But, that relative richness, we know Trump's playbook. Trump's playbook is the same thing every time. It's absolute disaster, dire straits, and the worst case scenario until the 11th hour when some unbelievable deal comes out or some extension comes out or something along those lines happens. So, maybe you're getting to levels now where you maybe want to fade Canada-US. Maybe the negative headline shock of 50% tariffs is priced in. And by August 18th, maybe those 50% tariffs are 20% tariffs. And, that might pave the way for Canada to give up some of its gains relative to the US.
So I guess my issue with all of that, and it's hard, like there's no disputing the fact that Trump kind of says something or proposes something that is extreme and it gets pushed back or watered down or delayed or altogether disappears. All that's true. But in this case, there's always a chance that that's not what happens. This is not that big in the grander scheme of things. Like there are already pretty chunky tariffs on bigger parts, bigger sectors. And what if this does happen? How about that? What if there aren't negotiations that are good enough from the U.S.'s perspective? And going down to 20%, I don't think really helps, because once you've kind of broken the barrier on USMCA eligible items now being tariffed, what's the point of the agreement in the first place? Like,
yeah, that's fair.
This thing, just toss the whole thing in the garbage, because you no longer have any certainty whatsoever. You might as well not even have a trade deal, which is why we have all those retaliatory actions that we do at the moment. If that's the case, like, I don't know, Canada's probably richens more. You end up with a wider output gap. You end up with then in turn weaker inflation, higher unemployment, so on and so forth. So, and the Bank of Canada said in the opening statements when they talked about the consecutive hikes, they also talked about if trade frictions with the U.S. were to worsen, then we could cut. I'm pretty sure more tariffs equals worsening in the trade relations and the broader growth outlook. That being said, I'm kind of with you. I do think they probably back off at some point. I mean, talks are supposed to intensify. Hopefully that happens over the next very near term days rather than weeks. But even so, I don't think you fade Canada yet. I think you want to wait like a couple of weeks. We're not going to get any now. You need a catalyst. There's no catalyst. I've been waiting for a catalyst for Canada to cheapen already. I already thought it was expensive before this. Now it's even more expensive. You still need a catalyst. There isn't one for like a huge cheapening, but to undo the recent move and what I think could be just some grinding richening over the next little bit would be a Trump announcement that the tariffs are delayed for, I don't know, pick an amount of time. And that would do it. But we're not getting that for at least 2 weeks.
No, definitely not. And so, maybe that trade is something that, it's important to kind of look at it in terms of scaling in. I mean, at this point, maybe at 145, you want to put on your first piece where you're long US, short Canada. And then as it moves to 155 over the next couple of weeks, you continue to scale in. I think there's some aspect of that. I'm only reticent because sometimes I look for these stretch targets and it just never gets there and you blink and then it's gone. So, but around these levels, I think you're going to see more client interest or just more client comfort with taking the other side of that. Because when that headline hits, the algo switch is going to flip on the futures and Canada is going to go bidless the other direction.
Yeah.
So when that happens, you just want to make sure that you're kind of well positioned for that.
So the one thing let me a little bit, even if they go bidless, if there is any kind of positive, I probably suggest that a USMCA deal is at least now possible versus seemingly not possible. You get a proper trade deal and Canada cheapens a ton. So if you miss the first 10 basis points, I don't think you care because it's probably a 50 basis point move whenever that time comes. It may not be for a while. Could be months, could be quarters, could be weeks. I don't really know, but something at least to keep in mind. So I think directionally we're the same way, but timing wise, maybe you could do a little bit here and kind of layer into the trade a little bit over time, but I don't think there's any harm in waiting. At least, I'd say it's 2 weeks, probably, like into early August.
Yeah, until you get something, or at least closer to the end date.
Yeah, use some kind of liquidity event. And summer trading's pretty terrible. Liquidity is not as good as it should be, or is the rest of the year. So if you get a pop in Canada, we richen a bunch on whatever. Pick whatever it is, like the U.S. cheapening, honestly, is probably what's going to do it, not Canada moving on its own. Use that as an opportunity.
Yeah. And I mean, another part of it is probably, this isn't necessarily just a Canada story. I mean, another big part of this is U.S. Yep. U.S. yields have been just continuing to chug higher. They've been driven higher and higher by real interest rates.
Bidless, some might say.
We were looking at 30-year real rates are about as high as they've been since 2002.
Multi-decade highs.
Yeah. This is the last time we were kind of up in this context. There was a brief stint in 2008 during the start of the financial crisis.
I don't even count that. That was because the market broke.
Yeah, market broke.
That's the only reason.
And then 2002, like we were looking at, was probably too close to when tips were first issued. So it was a very different market. There was way less liquidity, way less duration. So it was a little bit different. But certainly I think, market participants need to kind of pay attention to real yields pushing up into these 3% levels. It seemed like they're kind of driving the bus here and
well, not yet for risk assets. You'd think that stocks would be under some pressure on the back of the increase in real yields, but not at all. And credit spreads also mostly well-behaved. Provies are a little bit wider, but not on the back of that.
Well, they're a little bit wider recently, but like I was comparing to where we were in April, and long interiors were at 80 in April, and now we're at 73. So we've backed up. I mean, back then we went from 80 to 66, back to 80 in a heartbeat. So, for anyone who at that time was like, I don't know what to do, I'm going to put on a carry trade. Well, guess what? That's worked out great. Your carry trades have worked out just fine. Spreads have continued to grind tighter. I think we were talking about CMB Ontario spreads at the time being near their tights at 23, and lo and behold,
back.
well, now they're at 18. They're even tighter than they were before. So if we were priced for perfection in April, now we're priced for perfection with a cherry on top. So I don't know. It's a tough environment because, you can make an argument where you want to de-risk and you think this time it's different. Wow, now we're really overvalued and valuations are really stretched.
Is that why I sold some stocks today?
Well, yeah, but 6 months,
should
6 months from now, we could be in the same place.
Yeah.
Will we be in the same place 18 months from now? I think it's a little harder to make that case. One thing I think is very interesting is even with the rate vol, we talked about where like long Canada yields were, where yields were back in April and kind of where they were now. We did this full round trip. One thing I find interesting is that US vol is still very, very compressed. And now there's obviously positive correlation to rate vol and outright levels and yields and shapes of curves. But, as we continue to see risk valuations skyrocket higher and yields continue to push into cheaper and cheaper territory, especially in the US, I don't know. It doesn't make sense to me why vol would continue to cheapen. I know there's been a lot of vol selling, and that actually has worked out well because vols were cheap in April and they're even cheaper now. But, at some point you have to say, okay, if it's not going to cost me a lot of money to put on the lottery ticket for this whole thing blowing up, maybe now is turning into a good time to do that. So maybe that's receiver spreads. Buy a 25 out of the money receiver against sell a 75 out of the money receiver. You can do that pretty cost effectively at this point just because vol is so cheap.
That doesn't sound terrible. We could easily move 25 beeps from here.
Absolutely. We did more than a 25 basis point round trip even since our last time we spoke.
Exactly. Okay. What else you got?
So like market health, we talked a little bit about the hyperscalers. That was a lot of bonds. There was a lot of bonds. The hyperscaler deals haven't performed particularly well. There's definitely
understatement of the situation.
Yeah, there's definitely been some pretty considerable pressure in investment grade credit spreads.
I guess it could be worse. You could be in the one in the US.
The Oracle
punishing
the Oracle deal in the US, which was about 75 wider in
SpaceX also
15 days. SpaceX as well. Yeah. So there's a couple of cracks out there. I think Provies have actually held in fairly well, considering they've actually tightened over that time period. If you look at like investment grade corporates on the back of some of this hyperscaler issuance, a number of them are actually wider. So in that metric, maybe you're actually saying, Provies have they did their job. They were a protective asset, but maybe they actually look a little bit rich against some other corporates.
But issuance is not what people thought it would be.
True.
Deficits are issuance programs are larger given the huge offshore issuance they've done so far. So I think that's really supported things and probably continues to. I would assume the domestic side of thing ramps up a little bit.
Yeah.
Just given the volume.
I think
international, they have to.
It has to.
Yes.
The domestic side of provincial issuance has to ramp up.
That's fair.
Because unless all these provinces are totally okay with allocating, growing their international issuance side from 25% to 50%, which they're not. They all state what their intended international issuance is every year. And there's probably a band there and there's a little bit of room, but at the end of the day, they need to lean more into the domestics, which is probably going to happen in the second half of the year.
Yep.
So I could make an argument there where I maybe would like to take some of my chips off the table in terms of like provincial spreads.
I can believe that.
Particularly in the long end, because really the international issuance is focused in 7s, 10s, 30-year sector gets usually saved for long end issuance.
But
the only caveat is outright yields.
Well, but not so outright yields one. And if you look at 10-year spreads on a constant maturity basis, like they're as tight as they've been in ages.
Yep.
And so like longs are not nearly at the tights the 10s are. So if there is some kind of blow up, 10s I think take the brunt of it personally.
Yep. That could be possible too. And they probably will oscillate between 10s and 30s and 10s and 30s, and they'll go where the market's giving them the most demand. But yeah, I think either way we agree domestically they're going to be more focused once the fall hits.
Yeah, I think so. That's fair. And that could put some pressure on, at least a little bit of pressure on spreads on the margin going forward. But I have to think 10s hurt a little bit more. They're just so tight. But there are more buyers in that space, so maybe that's just what keeps things hanging in for now.
Yep.
Fair enough. Okay, that's Provies. CMBs, things are quite tight there as well. I mean, they're
Not on a relative basis.
still
though.
really, no, that's it. So they're not relative to Provies, they're not, but feels like there's only so far they can tighten relative to Canada's.
Yeah, at some point, I think you're gonna. I mean, they're not going to trade through Canada's, so there's going to be some sort of G spread stickiness where they're not going to be able to kind of trade through. Maybe that's your sort of risk off hedge trade where you say, okay, I'm happier to own, particularly in 10-year CMBs. I still do think there's a mismatch in the market in terms of product available to be sold into the CMB program in the 10-year space and 10-year CMBs. So if I had to pick a sector, that's one where I think there's fundamental reasons to own in the 10-year, mainly because there is no 10-year multifamily mortgages getting written at this point.
Limited.
Very limited. Yeah. Very limited. The curve is too steep. And so as a result, I think the 10-year CMB issuance side might be a little lighter. And if you're a bank treasury portfolio, that's an area where you probably want to own something that's a little bit longer. And if there's not going to be as much issuance or it's difficult for them to fund that program with mortgages, then I think you want to be long that stuff.
And it's cheap compared to Provies, which is at least as important, I believe. Just last but not least, like we touched a little bit about the long end. We're flirting with 4% again today. That's a level that hasn't been definitively broken yet. We did pop above it a couple months ago for 3 days, I think, and then right back down. Last time was oil price driven, the pop in yields. This time, seemingly similar. It looks today like the long end's holding in a little bit better. It is Wednesday the 22nd, and it's the afternoon. By the end of the European day, their long end had closed richer after cheapening in the earlier part of the day. The U.S. is off its weakest levels. I think it touched 515, 16.
Yeah.
And then it's rallied at 15, and then it rallied back. Canada was just above 4%. Now it's rallied back. Maybe there's some resilience there. I don't know.
Yeah, I mean, four we've tested, like you said, a couple times in the past, and like 4 seems to have been the magic number where investors have drawn a line in the sand. One thing I would say that I think is probably notable is that the last time we hit 4% in the long end, we saw a phenomenal amount of outright buying, and we've seen buying around this level, but it hasn't been as sizable as what we saw the last time. The last time that we saw this 4% level in the long end Canada, we saw a phenomenal amount of buying. Now, part of that might have been based on what time of year it was. Again, this was back at end of March, beginning of April, after a pretty big yield sell-off. And we saw, there were fundamental reasons to be long Canada. There were extensions coming up, whatnot. So we saw a phenomenal amount of buying. We have seen buying. It's not to say that we haven't, but I would say we haven't seen the same amount of buying that we did then. It's been picking away selectively by a couple of more active type accounts. And I would say you're also seeing that in the auctions. I mean, we've now had, even with yields continuing to cheapen up, our last 3 to 4 Canadian government bond auctions really haven't gone that well. The tails have been bigger. The bid to covers have been a little bit smaller. There was obviously the kerfuffle and the fat finger on the new Canada 2059. So that aside, but in general, the auctions haven't gone particularly well. So, I don't know if that's a liquidity thing, a summertime thing. People have some exhaustion at this point.
Don't think they come too rich. That's my issue with the auctions.
Yeah.
It's like when the new bond used to come, it used to come cheap.
Yeah.
Now, for whatever reason, it doesn't come cheap, and then the auction goes poorly, and it's like, well, yeah, because it wasn't cheap enough for people to buy. What did you think was going to happen?
I'd say today's 10-year auction, the WI wasn't too bad. Like compared to what 35s were. No, it wasn't cheap, but it wasn't terrible. It wasn't like the 59s auction when that came. That WI looked quite expensive. And so, I will say that today's auction looked okay from a value perspective going into it, and there was a reason to want to own 10-year yields, but even then, kind of a weak auction. So I don't know. This could be a summer thing, some liquidity thing. People need to see more catalysts. We're really in a holding pattern with data. We're in a holding pattern with our relationship with the U.S. We're in a holding pattern with regards to the Iran situation. So, maybe there's a little bit of fatigue there, and that's sort of letting yields drift higher. So all that to say, at 4%, given that I haven't seen as much buying this time around, I think we could maybe break out of that 4% range and maybe push a little bit higher.
I'm less convinced. I think only if the rest of the world also pushes higher.
Yeah.
I don't think we do it on our own. And even if the rest of the world sells off, I think we still outperform. So yeah, we could go higher, but it'll take the US going higher, the UK going higher, Europe going higher, Japan going higher. We'll follow suit, but we will outperform in, I think, any scenario, especially over the next few weeks. Like when you have the cloud, the new tariff cloud hanging over Canada, it's going to be really hard for the long end to get crushed unless something else happens. I don't know, in case there's some new fiscal stimulus measure announced, or who knows. We'll have to wait and see on that one. All right, Adam, do you have any? You want to give us any trade ideas, or should we pass on that for this one? Given that there is a extreme amount of uncertainty, and quite frankly, I think both of us have already said that we like shorting Canada against the U.S. I'm a little bit hesitant here. You like starting here and adding as we go, and by the next time I have you on, we should probably be at a cheaper level. That's how I would look at it.
Yeah, I also mentioned I like real yields. I think you probably want to get some exposure to real yields here just on an outright basis. I mean, if you're a pension plan, you're an insurance company, and you're looking at real yields at 3%, that's a pretty, as a proxy for growth in developed countries, that's a pretty great level to get long. So I like real yields, so I'd love to see where those are at the next time I'm on. So that'd be another thing that and vol. Also, just to rehash that, I think this is not a bad place. Like if we're talking about potential blowups, and we think it's an outside chance that the U.S. is going to really go hard after Canada, and this could be a real big problem. But if you can buy that possibility for fairly cheap because vol is cheap, then I think you look at buying I don't know, it's a 1 year, 2 year receiver spread, a 6 month, 1 year receiver spread. You look for ways to get long Canada where your max loss is your premium.
All right, Adam. Enjoy the rest of the summer.
Thank you very much, Ben. I'm really looking forward to it. It should be great.
Have a good summer, everybody. Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.